Okay, welcome everyone. And now we're going to add one more layer of complexity. That seems to be what we keep doing here. Going through chapters 1 through 3, we started out with just simple equity method in chapter 1. And chapter 2, it was the consolidation on the exact date that we bought the 100% ownership of a subsidiary. And so at that point we weren't dealing with anything other than a 100% ownership, and we weren't having to deal with what happens as you move through time. We were just making an assumption. We bought the company at the end of the year, bought all of the company, and that's basically what chapter 2 was. Chapter 3 then added the layer of complexity where we then moved through time, and we had 1, 2, 3, 4 years of activity, and you had of course the choice between initial value or partial equity or full equity on the way that you accounted for that subsidiary on your books. But again, in chapter 3 as well as chapter 2, it was a 100% ownership of this other company. Now what we have is what's called a non-controlling interest. So we're not going to buy 100% of the outstanding stock. We'll buy somewhere between 50.1% and 99%, and we'll have this outside ownership, also called a non-controlling interest, or we abbreviate it to be NCI. So let's move forward and see what we're up against here. We talked about it somewhere less than 100% ownership. That we're still going to have control, but somewhere above 50%, but less than 100%. So who is it? It's the non-controlling shareholders. That's that other party. Call it the complement, COMPLEMENT. So it'd be, our share plus their share will equal 100% of the subsidiary. Now we're going to have to reflect in the consolidated statements that share, that group of people, and what they own. And we'll show how that happens in a little bit. And we also show it actually extensively on the comprehensive problem at the end of the chapter. So the parent with the controlling interest must consolidate all of 100% of the subsidiary's financial information. So every caption on the balance sheet, all of the income statement, they're going to show that on the consolidated worksheet. So it's not like we have to split every item, cash, receivables, fixed assets, bonds, whatever. We don't have to split it between the controlling and non-controlling interest. We're going to show that NCI as its own caption. So we're bringing over 100% of the items of the subsidiary on our consolidation. Now, the acquisition method, which is what we're under here. Okay, that's the way things are done now. It's called the acquisition method, and it requires that the subsidiary be valued at an acquisition date fair value. Now, what is that total? The total acquired firm fair value in this partial acquisition, where I'm buying something less than 100% of the stock. It'll be the sum of these two items. The fair value of what I'm buying, of my controlling interest, whatever I assign and determine to be the fair value of that controlling interest. And I'll also have to then assign a fair value of the non-controlling interest as of the acquisition date. So let's see how that works. Let's assume Parker, the parent company, wants to buy 90% of Strong Company, the subsidiary. Strong's price has been trading for $60 a share. Now, in order for Parker to buy all of that stock, the 90% of that stock, they're going to have to pay a premium, something above $60, to get that stock. Let's assume they pay $70 a share to induce enough of these shareholders, in this case 90% of them, to sell. Now, what about that remaining 10%? Remember, we said the fair value of the firm has to be the sum of the controlling interest and the non-controlling interest. So we've got 10% that's going to be NCI. So how do we know how much to assign to them? Well, let's assume 9,000 shares at the $70. We're going to assume that that's going to be a quoted market price. That is what they had to pay. So if that's 9,000 shares, then we say the fair value of the controlling interest is $630,000. Now the remaining 1,000 shares, the 10%, those trade at $60. We don't assign the premium because we're not buying these 1,000. We're leaving them on the market. So you'll see the market price after the dust settles from this transaction will oscillate back to $60. So that's going to be then the basis. We'll take the $60 times $1,000 shares that represents the 10%, and we'll assign 60,000 to that, and then add that to the 630 and say the total value assigned is $690,000. So to recap, here's what we're doing. $70 times 9,000 shares is 630. $60 a share times $1,000 for the NCI, 60,000, for a total value assigned to the subsidiary of $690,000. Now, the acquisition date fair value, the amount paid of Strong, is 690,000 is greater than the fair value of the identifiable net assets, which are 600,000. And so we're going to use the stock price, which was 10,000 shares, which that's the entire company, that's everything that was outstanding, trading at $60. We're going to say, okay, the net assets were valued at 600,000. Now, so that we're going to allocate the difference to goodwill. Now, the first thing that the parent has to do is they're going to first allocate goodwill to its share, its controlling interest, for the excess of the fair value of the parent's equity interest over its share of the fair value of the net identifiable assets. So we know we bought 90% of the company. The net identifiable assets are 600,000. That's coming from here. And so therefore, my controlling interest share of the fair value of the net identifiable assets is 540,000. Simply 90% times 600,000. Goodwill will be allocated between my controlling interest and the NCI, and it will not always be proportional to the percentages owned. Now, what do we mean by that? And you'll actually see this on the comprehensive problem at the end of in the other video lecture. But let's walk through a simple example here. We know that the total fair value, remember that 690,000 was the sum of the 630,000, which was 9,000 shares times $70 a share, and then 1,000 shares times $60 a share. That's where we got the 690. Fair value of net identifiable assets, 600, and therefore we have goodwill of 90 for this entire acquisition date value. Now, how do we split it between our two columns of controlling interest and non-controlling interest? We say that the fair value at acquisition date, $630,000 for the controlling interest, and we'll take that 600,000 times 90% from the previous slide, the 540, and subtract that from the $630,000. Remember, this was a $70 a share times the 9,000 shares. So all of the goodwill of 90 is going to go to the controlling interest. I've got nothing left to allocate to the non-controlling interest. So this illustrates how you don't always have this proportionate share or proportionate distribution of your goodwill between controlling and non-controlling interest. And there is, as you can see, there is no excess goodwill to assign to NCI. So if the shares were not actively traded, the $70 consideration that was transferred by Parker would then be the best source to say, okay, how do I value NCI? You'd still take the $70. Now, we had a market, and the trading price was $60 without that premium, so that was on the previous example. And then in this example, we would go ahead and assign the $70,000 to the non-controlling interest. And sure enough, then with the way the math would work out, using $70 a share to NCI, we're then going to have that perfect proportional split of our goodwill. So you can see how that works when you assign this different value to the NCI. That's how you can get that disproportionate assignment of goodwill. But in this case, it carries through as a perfect proportional split because we had $70 a share here and $70 a share here. Now on the balance sheet, where do you put that NCI? It's a credit balance. Now your equity accounts normally have a credit balance, and you'll have a caption in your consolidated worksheet or your consolidated presentation called non-controlling interest, and that will represent their investment. Now this account is in the equity section of the balance sheet. Now the guidance we have right now is Statement on Financial Accounting Standard number 160. Now prior to that, they basically said we'll stick it as a in the liability section, kind of what they call a mezzanine item between the two sections, between liability and equity. And mezzanine, remember, that's a term that just refers to the floor of a building. Somewhere between the first and second floor is called the mezzanine level, and so that's no longer applicable. Now we just stick it right there as a caption in the equity section. Now the subsidiary's net income. So as a business, as a company, that subsidiary earned in a period, a quarter, a year, they earned net income. Now what we have to do, we have to first, as a consolidated, or excuse me, as a company, say what's the excess amortization. You know, that if you had to write up your assets to their fair value, and then that's going to cause some excess amortization. You got to deal with that. But what you're going to do to that, then after you've handled that excess amortization, you'll allocate to the owners, and that is going to be the parent, which represents the controlling interest, and then the non-controlling interest, to properly measure their respective equity or their share in that consolidated entity. And you're going to do that to the net income of that subsidiary business. So on the income statement, on your consolidated income statement, you'll have an account called the non-controlling interest and subsidiary net income. Now you'll see this in the other video lecture, so pay attention how we handle their share and how we split the income of the subsidiary, what it made during the period, how we split it and assign some of it to the non-controlling interest. So pay attention to the other lecture. Now the account that's created during the consolidation is reported in the worksheet entries. So remember, I keep repeating this point in these lectures, and that is you're doing a consolidation on Excel or some other software. And so what makes sense is you're going to have this roll forward, this carry forward file and all this information, and you're going to have all your work papers that indicate what you did to do this allocation. And then you'll make the entry on just your spreadsheet. It's not like you're making it to the general ledger. In fact, you don't make it to the general ledger. You're just putting it on the spreadsheet so that then you can present a consolidated set of financial statements to the SEC and to the investment community. Now let's do this simple allocation with some made-up numbers here, and let's assume that Strong earned $80,000 in the first year, and then you had quite a bit, actually, $30,000 of excess fair value amortization. So on my consolidated work papers, the entire subsidiary amount that I'm consolidating as $80,000. I take away that $30,000 excess amortization, leaves me with $50,000, and this is my split. So if I have an NCI that owns 10% of the stock, I've got to take 10% of that $50,000 and assign that piece of net income to the NCI. So you can see what we're doing there. Now the consolidated process is really unchanged from the way we've learned, or what we've learned so far in chapters 2 and 3. When you throw in the complexity of a non-controlling interest, you're still doing the same thing. You're just going to consolidate as though the parent has 100% ownership. So you're going to bring these, you're going to lay out on your columns your parent company and your subsidiary company, and you're going to add them across. But you're going to, of course, have your adjustments and your eliminations that you make, but you're going to do that as if there's 100% ownership. And then you'll determine the non-controlling interest at the beginning of the current year. Okay, and you're going to see that on the worksheet that we do in the comprehensive problem. You're going to assign the current year net income. You're going to assign a piece of that to that NCI. And then the current year dividend payments also, there's a piece that's going to those shareholders, say in this case 10% shareholders, they're getting a dividend, so that there's a piece of that, and then the other piece goes to the controlling interest that the parent company has. And then in the subsidiary as of the end of the year, that's where you're going to have kind of a small roll forward of that non-controlling interest. Again, pay very close attention to the other video where we explain how this is handled. So the non-controlling interest in the equity of the subsidiaries are reported in the owner's equity section of the consolidated balance sheet. Now, when it says statement of financial position, remember that's just a synonym for balance sheet. It's the same thing. It's meaning the same thing. The amount should be clearly identified and labeled and distinguished from the parent's controlling interest in the subsidiaries. Now, also the consolidated net income or net loss and each component of OCI, other comprehensive income, must be allocated to the non-controlling and controlling interest. Now, hopefully you remember OCI is a component of equity. And its typical use is when you're not running an income or expense item through the income statement, so you're going to show it in OCI. And a lot of times these are like your mark-to-market entries that you've had to make on let's say trading securities or available for sale securities. Actually, I think it's on available for sale. Trading is run through the income statement. So remember from your intermediate accounting, get out that book if you want to refresh your memory on what OCI is. All we're saying here, don't get bogged down in OCI. All we're saying is you're going to have to allocate OCI between controlling and non-controlling interest in your consolidation. So what does this look like simplistically? Here's your consolidated balance sheet of all your companies, and then you're just going to show as a caption in your equity, you're going to show that non-controlling interest there in your owner's equity. Now, likewise, on the income statement, you're going to allocate or bifurcate, in this case, the consolidated net income. You're going to show a piece going to non-controlling interest, and then the remainder goes to the controlling interest. Now, these numbers, look how they flow, because you're going to then say retained earnings, common stock, but you're going to show, as you're rolling forward your balances from January 1 to December 31, you've got to indicate what happened over here in non-controlling interest. That's what you're doing here with your both common stock and retained earnings. This is a combined amount for non-controlling interest, and then income and dividends. You're getting here from their share of net income, their share of the dividends, and then how you roll forward the entire equity of the non-controlling interest from beginning of year to end of year. Okay, what effects of using the initial value method? And this is just really kind of review a few things, because as I've said before, initial value method, which also the cost method, called the cost method, is the most common. And remember from initial value that you employ a cash basis for income recognition, rather than the accrual basis where the investment account is always reflective of income or loss from your subsidiary, and then of course reduced for any dividends that the subsidiary pays. And on the initial value, that you're recognizing dividend income on your income statement rather than flowing it through the investment and subsidiary account that you keep on your general ledger. So in many ways, the cost method or initial value method is the most simplistic way to go, and it's most common. You do not accrue the percentage of the subsidiary's income. Again, this is review. This is stuff that you should remember from chapter 2 and chapter 3. And likewise on the amortization expense, you're going to keep, how do you handle this in practice is really you keep what I call a permanent file, and you're keeping records, and you say they're spreadsheets or just documents, but you're keeping track of what you do in prior years, and so that when you get every quarter and you're having to do these consolidated financial statements, it's not really problematic. You're pulling out that file and you're saying, oh yeah, that's what I do, and this is kind of the steps I need to go through to produce those financial statements. So this is really, you know the difference between initial value and full equity. So this is all part of review from what you've had before in your prior chapters. And not to go through all the entry labels. Again, this is stuff you've had in the past. You can review this on your own if you want, but we don't need to spend time here on the video lecture. Again, it's right out of the textbook and pretty straightforward. Partial equity, again, I'm not going to hold you to this on the test, but the partial equity is they're accounting for it a little bit differently. It's kind of a hybrid between the cash basis, which is your cost method, and your full accrual, which is your full equity. So it's just, again, just a little bit different. Non-controlling interest, when you have GAAP and IFRS, there's pretty good convergence between the two. The GAAP, you can read that. This is what we've talked about. That's what we're teaching. IFRS would permit fair value measurement, or the non-controlling interest may be measured at a proportionate share of the subs and identifiable net assets fair value. So in that case, you're going to have a proportionate split of your goodwill. Now you do this value excluding goodwill, but again, you'll just take that proportionate share times the fair value of that company. and then they're going to assign the goodwill to the controlling interest. So don't bog down with IFRS, because you're going to be following GAAP and going to be tested on GAAP. In summary, so the control does not require 100% ownership. Remember, to have control over a subsidiary just means you have of the voting stock, you're somewhere above 50%, and you don't have to be at 100. So that's what we're talking about, is that range between 50 and 100. And what do you do with that NCI? The minority interest, ownership interest by outside unrelated parties, is called non-controlling interest, NCI. You'll hear that a lot. The valuation principle for that non-controlling interest is acquisition date fair value. That's nothing new. That's what we've been teaching all along. And each of the subsidiaries' assets and liabilities are included. You're bringing them over in whole to the consolidation, and then you're going to just have this caption for NCI. And remember, this is, again, review. Any remaining excess fair value beyond the total identifiable and assigned net assets is what you put to goodwill. Now, the book talks about a mid-year acquisition, but this is common sense basically when you think about it, because up until the date that you do an acquisition, and let's say you buy 90% or 70% of the stock, whatever that percentage is, the pre-acquisition revenues, so everything up to that date, and the expenses of that subsidiary, you exclude that from your consolidated results. That's not part of the consolidated entity, so it doesn't present that much of a problem in doing your spreadsheets, and the book does a pretty good job of walking you through that, but I'm not going to test you on the mid-year, and again, it should make sense to you.